We're here with Adam Posen, an external member of the Bank of England's Monetary Policy Committee. Adam, we've had a lot of data in the past couple of weeks, in particular inflation at 3.7%.
Yeah.
What's your outlook for the UK economy and how has this changed?
We're heading into our quarterly forecast round right now, and so I'll give you my view, but this will be influenced before my next vote by my interactions with the other members of the MPC and the staff doing the forecast. Where I am right now is basically unchanged from the last speech I gave in Billericay in December. I think the underlying UK inflation rate, determined by the domestic fundamentals, the domestic factors, is really unchanged. We have one-time shocks to the exchange rate, to commodity prices, and obviously to VAT, which everybody agrees we shouldn't be taking into account, that have to be taken out from the inflation rate to see what's really going on. More importantly, going forward, I see an absence of those shocks. Sterling has been very stable. There's obviously been a little movement in commodity prices, but it's not clear that's going to be sustained. And so, in the absence of that, next year, I still expect consumption to go down because of people saving. I expect there to be a short-term impact of the fiscal consolidation that will drag on consumption further, and I expect spare capacity in the economy to push down on inflation as well. So I still forecast that inflation will be below target at the target horizon based on the underlying fundamentals.
What external factors may cause you to reconsider?
What has changed for me, indeed, are the consideration of external factors. I have more awareness of the risks to the UK inflation outlook from abroad along two lines. First, there could be sufficient upside surprise and growth in our major trading partners, particularly the euro area, that could have effects on not just UK demand for goods and services from the UK, but also on the exchange rate and the interest rate in the euro area. And that would be, given what we've already said about how much more powerful the impact of exchange rates was on inflation over the last couple of years, we would have to take that into account. Now, I'm very much welcome the news, the positive news we've been getting out of Germany and Central Europe. But I think at present that news is not sufficient to offset the downward drag on consumption and thus on inflation that I'm expecting. I will monitor that. The second factor is obviously commodity prices, and we're just going to have to see whether this is a temporary spike of the sort we saw in '08, in which case it's wrong to overreact, or whether this is a sustained trend.
Adam, thank you very much.
Thank you.